Well, I've said many times that if you get to be 65 or 70 and later, and
Ever pondered on the origins of the world's most successful investors? Surprisingly, it all kicked off with just a few dollars. Today, let's delve into the mindset of Warren Buffett to uncover the secrets of investing modest amounts. This isn't your run-of-the-mill investment strategy. We're unveiling how Buffett turned small sums into a colossal fortune. If you've ever felt your savings were too meager to matter, this video is set to shift your perspective and guide you on the journey to financial growth. So let's dive right into it. In his early days, Buffett didn't swim in millions. He operated with a modest capital. Despite that, he pulled off extraordinary returns, laying the groundwork for his future triumphs. How? It all boiled down to his distinctive approach to investing, a focus on undervalued opportunities that flew under the radar for many. Buffett's strategy during these crucial years was straightforward yet profound. He scoured the market for stocks that weren't merely cheap, but significantly undervalued compared to their intrinsic worth. This involved delving into companies often overlooked, be it for their size, perceived dullness, or temporary challenges that made the average investor wary. Buffett delves into his stock selection approach, and it's not just about grabbing low-priced stocks. He's on the hunt for quality businesses trading well below their actual value. This method demands thorough research, deep dives into financial statements and market reports, and a comprehensive understanding of the business models in play. His early investments didn't target the big buzzworthy names. Instead, Buffett sought out hidden gems in the market, small, unglamorous businesses with solid financials and robust business models that the market undervalued. During this phase, he often referred to his strategy as cigar butt investing, a term he borrowed from his mentor Benjamin Graham. We aim to be in solid businesses. Our focus is on businesses that will not just be good, but better a decade from now, and we want to acquire them at a reasonable price, clarified Buffett. Years ago, he moved away from what he termed the cigar butt approach to investing. This involved seeking out distressed companies selling so cheap that there's one last valuable puff left. The analogy spoke to finding a cigar butt with a single puff left, purchased for less than the value of that puff. In investment terms, it meant acquiring a stock at a low enough price to secure a profit, even if the business underperformed. This phase in Buffett's journey is pivotal for small investors. It underscores that substantial sums of money aren't necessary to start investing successfully. What's crucial is the ability to spot undervalued companies and the patience to wait for the market to recognize their true value. Buffett's principles for small investors are clear. Principle 1. Look for undervalued opportunities. Buffett's primary principle revolves around identifying undervalued companies that the market has overlooked. These opportunities frequently reside in smaller, less prominent firms that haven't yet grabbed the attention of major institutional investors. The crux of the matter lies in pinpointing businesses trading below their intrinsic value. By steering away from the cigar butt approach, Buffett shifted his focus to sustainable, long-term investments. This strategic move is emblematic of his belief in businesses with enduring value and growth potential. The analogy of a cigar butt with one last puff, purchased at a price lower than its value, encapsulates his previous strategy of profiting even from struggling companies. For small investors, this shift in Buffett's approach holds significant lessons. It underscores that substantial capital isn't a prerequisite for investment success. Instead, the critical elements are astute identification of undervalued companies and the patience to await market recognition of their true worth. Principle 2. Do your homework. Buffett underscores the significance of extensive research in investing. It's not just about numbers, it's a comprehensive examination of the company's business model, financial statements, management quality, and competitive standing in the industry. Unpacking the intricacies of the business requires delving into how the company generates revenue, evaluating its growth potential, assessing the durability of its competitive edge, and recognizing the inherent risks. For Buffett, understanding a business goes beyond superficial evaluations. It's about gaining insights into the core mechanics that drive its success. This meticulous approach aligns with his philosophy of investing in businesses that exhibit enduring strength and have the potential to thrive in the long term. Through this lens, he seeks out companies with robust fundamentals, competent leadership, and a strategic position in their respective sectors.
Well, by far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, and both in writing and in person.
Principle 3. Be bold, but not reckless. Buffett's wisdom emphasizes seizing great investment opportunities without hesitation, advocating for a substantial allocation in one's portfolio. This approach challenges the conventional idea of diversification, as Buffett believes it can dilute returns when investing in mediocre businesses. However, he also warns against recklessness, highlighting the need for boldness while remaining acutely aware of the associated risks. Implementing these principles offers a potent strategy for individual investors to transform modest investments into substantial wealth over time. Recognizing the growth potential of an investment is crucial, underscoring how small investments can yield significant returns, a concept Warren Buffett has adeptly employed throughout his career. Imagine a scenario where you kick off with a $10,000 investment in a stock that, after some solid research, seems significantly undervalued. Let's say this stock experiences an annual growth rate of 20%, not uncommon for a carefully chosen small investment with solid fundamentals and growth potential. Fast forward 10 years and the magic of compound growth unfolds. Compound growth, often touted as the eighth wonder of the world, means you're not just earning interest on your initial investment, but also on the interest that keeps piling up over time. In this case, with a 20% annual growth rate, that $10,000 investment would not just grow, but more than sextuple, reaching over $61,000 in a decade. The remarkable surge owes its thanks to the compound interest effect, where each year's gains get reinvested, churning out their own gains in the years that follow. This type of compound growth is precisely what Buffett leveraged in his early investment journey. Recognizing that even modest sums, wisely invested in undervalued, high-potential stocks, could blossom over time. The essence of this principle endures today, underscoring that successful investing isn't solely about commencing with a hefty sum, but making astute investment decisions and letting time do its work. Whether you're kickstarting with $1,000, $10,000, or any sum, the core tenets of wise investing hold steady. It's not about the initial investment size, but how shrewdly you invest. Let's delve into real-life instances from Buffett's experiences where he applied these principles. Warren Buffett's investment in Geico. Buffett's venture into Geico reflects his distinctive investment approach and knack for identifying potential in its early phases. His connection with Geico traces back to his early 20s, during his time as a student under Benjamin Graham's guidance at Columbia University. What caught Buffett's attention was the revelation that his mentor, Graham, had a significant stake in the company. Fueled by curiosity and a quest to comprehend the business, Buffett embarked on a journey to Washington, D.C., looking to glean insights directly from Geico's source. Arriving at Geico's headquarters on a Saturday, he found the offices closed. Yet fortune smiled upon his audacious move as he crossed paths with Lorimer Davidson, Geico's vice president, who happened to be working that day. Davidson graciously spent extensive hours with Buffett, unraveling the intricacies of the insurance business, particularly Geico's distinctive model. Geico, unlike traditional insurers relying on agents, opted for a direct-to-customer approach. This strategy enabled Geico to provide lower premiums, a game-changing advantage that caught Buffett's keen attention as a pivotal moment in the insurance sector. Captivated by Geico's innovative business model and its promising potential for growth and profitability, Buffett made a bold and unconventional decision. He committed over half of his net worth into Geico stock, showcasing not only his confidence in the company's future, but also his readiness to substantiate his beliefs with substantial capital. This investment move was grounded in a profound grasp of Geico's value proposition and its potential to shake up the traditional insurance landscape. In the subsequent months and years, Buffett's bet on Geico yielded remarkable results. Geico's growth soared, making it one of the largest auto insurers in the U.S. The company's upward trajectory and expanding market share transformed Buffett's initial investment into a substantial fortune. Buffett's investment in Geico shines as one of the most triumphant in his career, highlighting his knack for spotting and leveraging long-term value. It mirrors his investment philosophy, characterized by meticulous research, a keen focus on business fundamentals, and the boldness to make substantial investments in companies with robust growth prospects. Warren Buffett's investment in American Express. Warren Buffett's investment in American Express during its early 1960s crisis showcases his contrarian investment approach and knack for identifying opportunities amid adversity. The salad oil scandal, a pivotal moment in American corporate history, unfolded as a significant challenge for the burgeoning financial services company. Caught in a major financial fraud, American Express found itself entangled in the salad oil scandal. Its subsidiary, American Express Warehousing, had unwittingly extended loans against tanks supposedly filled with salad oil, later revealed to be mostly water. This scandal not only inflicted substantial financial losses on the company, but also triggered a sharp decline in its stock price. Investor confidence dwindled, and the market grappled with uncertainty in the aftermath. But in a scenario where many investors perceived disaster, Buffett spotted opportunity. Instead of going with the crowd, he undertook a meticulous analysis of the situation. Buffett's method was hands-on, rooted in real-world observation. He personally visited numerous restaurants to assess the widespread acceptance of American Express cards and conversed with users of their services. These interactions were Buffett's way of grasping the actual impact of the scandal on the company's core business operations. Through meticulous analysis, Buffett uncovered a pivotal insight. The salad oil scandal, though serious, hadn't fundamentally eroded the intrinsic value of American Express's core credit card and travel services business. Recognizing the enduring strength of the company's brand and market position, he viewed the scandal as a temporary setback rather than a permanent impairment. Fueled by this conviction, Buffett took a bold investment leap. Allocating around 40% of his partnership's assets, he invested in American Express stock, a daring and unconventional move amid prevailing market sentiment. This decision epitomized Buffett's investment philosophy, highlighting the importance of understanding a company's fundamental value and the willingness to act decisively when opportunity knocks. The subsequent revival of American Express validated Buffett's bold move. Navigating through the crisis, the company not only restored its reputation, but also witnessed a rebound in its stock price. Buffett's investment didn't just bring substantial returns for him and his partners, it cemented his status as a shrewd and astute investor. It showcased his knack for cutting through market noise, staying focused on long-term value, and making investments others hesitated to consider. Now we want to hear from you. What are your experiences with small investments? Have you stumbled upon any hidden gems in the market? Share your stories and insights in the comments below. Let's keep the conversation going and inspire each other to make intelligent, informed investment choices, regardless of the size of our portfolio.